Welcome to Pennywise Books, where we turn timeless books into rich, engaging conversations that feed your mind. If you've ever wished for full book value with zero reading, you're exactly where you need to be. Settle in. Today's book might just unlock a new way of seeing money. And if you find this useful, insightful, or even just a little inspiring, go ahead and subscribe. It helps more curious minds find us too. Let's dive in.
Welcome back to the Deep Dive. Today, we are strapping in for quite an intensive session. We're not really focusing on stock tickers or, economic forecasts today.
No, not the usual stuff.
Instead, we're diving deep into the operating system, the mindset running inside the heads of the world's most successful financial players. We are talking about the market wizards.
That's right. And our source material today really revolves around those landmark interviews compiled by Jack D. Schwager.
Essential reading for many traders.
Absolutely. And it's far more than just a collection of trading tips,
Sure.
It's really Schwager digging into the fundamental attitudes, the risk management ideas, the mental models. Basically what allows certain people to consistently pull vast sums of money out of the market.
And the market, well, it's famously tough, often called the zero-sum game, right? Where maybe 90% of people who try end up losing money.
That's the common statistic, yeah.
It's brutal. So our mission today is to really pull out the common threads. What are those definitive common denominators?
We're looking for the intellectual and psychological architecture, you could say.
Exactly. What separates these elite wizards from, well, pretty much everyone else who's struggling?
And can success be taught? That's a big part of it, too.
Right. If it is teachable, we want the blueprint. Let's find it.
Okay, so what makes Schwager's starting point really interesting, I think, is that his whole quest for this knowledge,
Yeah.
it didn't come from him being a total failure.
No, quite the opposite in some ways.
Exactly. It came from this deep sense of self-dissatisfaction, even though, objectively, he was a successful trader. Commodities, futures. He was consistently making money.
Net profitable, yeah. And he'd actually multiplied his starting stake tenfold. Not once, but twice, right? Which is incredibly hard to do.
Very difficult. And he had good timing, too. He could anticipate major market shifts.
So by most standards, he's doing great, but he still felt this, what did he call it? A sense of failure.
Yeah, a sense of failure. That's the phrase he used.
Why? Why the harsh self-assessment when things looked pretty good on paper?
Well, it seems he felt he'd hit a wall, a ceiling.
Okay.
He just couldn't push his total trading equity much beyond the $100,000 mark.
Okay. Stuck at that level.
Right. And he felt that, given how much he knew about the markets, his intellectual ability, his knack for diagnosing trends, his actual results just fell way short of what he thought his true potential was.
So this personal paradox, being profitable but feeling stuck, unable to scale up, that's what drove him to write the book.
That was the engine, yeah. He was essentially asking himself, look, if my knowledge is sound, why am I stuck here?
The answer couldn't just be technical then.
It had to be something else,
Yeah.
something non-technical. So he decided to go ask the people who had broken through that ceiling. And we asked them directly, what are the key elements to your success? What am I missing?
And that journey, that quest, ultimately led him to challenge, well, basically the bedrock of modern finance theory, the efficient market hypothesis.
It did.
Okay, let's unpack that a bit for everyone listening, because understanding why that theory might be flawed is pretty central to why the wizards could even exist.
Absolutely. The efficient market hypothesis, the EMH, it's the dominant idea in academic finance.
Right.
And it basically says that all the publicly known relevant information about a stock or an asset, it's instantly reflected in its price, baked right in.
Instantly. So there's no edge to be had from information because everyone has it and the price already shows it.
Exactly. Which means the market can't be consistently beaten. You might get lucky, sure, but you can't systematically outperform because there are no persistent mispricings to exploit.
And this isn't just some abstract theory, right? It underlies a lot of real-world stuff, like how banks assess risk.
Oh, absolutely. Risk modeling, portfolio allocation. A lot hinges on the EMH being broadly correct.
But if the EMH holds true, then a trader who consistently posts amazing returns year after year, that shouldn't be possible.
Statistically, it would be like winning the lottery every single week for a year. It's a mathematical impossibility under the theory's assumptions.
Right. And Schwager comes along and says, hold on, I've got proof this theory is deeply flawed.
He does, and he uses some really powerful data points. The most startling one is the market crash of October 19th, 1987, Black Monday.
Black Monday, where the S&P futures just
Tanked is putting it mildly. They fell 29% in a single day.
29%.
Yeah.
And it's the numbers connected to that event that really poke holes in the EMH, isn't it?
That's where it gets truly wild. If you assume, like the EMH models do, that price changes follow a nice, neat, normal distribution, the standard bell curve.
Yeah, the bell curve we all learn about.
Right. Based on that assumption, the statistical probability of the 1987 crash actually happening was calculated to be 10 to the power of minus 160.
Wait, say that again? 10 to the minus.
$1,060.
Okay, that's
Yeah.
I mean, that's basically zero. It's not a real number in practical terms.
It's so far beyond zero, it's absurd. To give you some context, think about the number of atoms estimated to be in the entire observable universe.
Yeah, okay. Which is enormous.
Right, something like 10 centels. The probability of the crash under EMH assumptions was less than the odds of randomly picking one specific atom out of all those atoms in the universe, and then doing it again, totally independently, and picking the exact same atom twice in a row.
That's impossible. So the model just completely breaks down.
It fundamentally fails.
Yeah.
Because real-world markets have fat tails. They have panic, they have euphoria, they have volatility that just doesn't fit inside the neat, tidy assumptions of a bell curve. The EMH models couldn't account for that kind of real-world risk.
So the market doesn't always follow a predictable curve. And the very fact that these wizards exist, the people Schwager's interviewed, with their decades of compounded returns that dwarf the averages, that's real-world proof, too.
It's living proof that systematic skill can exploit these gaps, these inefficiencies, these moments where the models fail.
So the conclusion is, yes, markets can be beaten.
Yes, but, and this is the crucial caveat Schwager immediately adds.
There's always a but.
There is. He stresses, doing so is very difficult, extremely difficult. It takes this rare combination of aptitude and discipline that frankly, most people either don't have or aren't willing to cultivate.
Which leads us right into that classic debate. Nature versus nurture. Is this kind of success about pure hard work and grinding it out, or do you need some kind of innate special talent?
Schwager seems to land on it being a mix. He uses a really good analogy running.
Okay.
He says, look, most people, if they train hard enough, if they're dedicated, they probably become proficient enough to run a marathon.
Right. Achievable with hard work for many.
Achievable through sheer effort and discipline. But, he says, to run an elite professional level marathon time, like a 2.15 or 2.30, that requires something more.
Yeah, not everyone can do that no matter how hard they train.
Exactly. That takes a very small minority of people who are just born with the right physical characteristics, the right lung capacity, the right muscle fiber type, whatever it is.
So, translating that to trading, you can train yourself, work hard, learn the discipline, become a competent, maybe even profitable trader.
Yes. Proficiency is achievable.
But to get to that extraordinary level of success, the kind we see in the market wizards, the multi-million-dollar breakthroughs, you need something extra, an X factor.
That's what Schwager suggests. He calls it innate talent, or maybe an inner radar.
An inner radar, like intuition.
Kind of, but maybe grounded in something real. It's probably not mystical. It's more likely an elevated capacity for, say, pattern recognition or synthesizing huge amounts of data really quickly. And maybe, most importantly, this inherent, almost subconscious emotional detachment from the money, from the outcome.
Being able to stay cool under pressure.
Exactly. And he warns, no matter how many hours you spend staring at charts, if you fundamentally lack that baseline aptitude, that inner radar, the truly elite level of performance might just always be out of reach for you.
But that creates a bit of tension, doesn't it? If some innate talent is required, how do we square that with the idea that trading skills can be taught? Which we'll see later with the turtles experiment.
That's the fascinating puzzle. And looking at the actual stories of success helps bridge that gap.
Right. The stories Schwager collected in Market Wizards show a couple of really key things. First, trading is one of the few fields, maybe the only one, where an individual person,
Starting relatively small.
yeah, starting with a fairly small bankroll, can genuinely become a multimillionaire, purely based on their intellectual performance and their psychological strength.
Performance and discipline, not connections or inheritance.
Exactly. And the second thing is that the paths people took to get that wealth, they are wildly different.
Okay, give us a taste of these stories, because some of them are just incredible.
They really are. You've got Michael Marcus, for example. This is a guy who failed repeatedly early on, wiped out, went bankrupt several times.
Wow, so he didn't start out a genius. Not at all. but he refined his discipline, learned the hard lessons, and eventually turned a starting capital of $30,000 into $80 million.
30,000 to 80 million, okay.
Then there's another story, a former securities analyst. Over a 7-year stretch, his average monthly return was 25%.
Monthly.
25% per month, on average.
Let's just pause on that. If you compound 25% a month, that's an annualized rate of what? Over 1,400%.
It's over 1,400% annualized.
Yeah.
For 7 years straight.
I mean, most professional investors dream of maybe hitting 25% in a single year, let alone averaging that per month.
It's just staggering performance. And then you have to mention the MIT grad, an electrical engineer.
Okay, a quant.
A serious quant.
Yeah.
He applied rigorous, quantitative, computerized methods, and his systematic approach yielded a cumulative return over 16 years of 250,000%.
250,000%. These numbers almost don't seem real.
They really do challenge the idea of a level playing field in finance, don't they?
Yeah.
It's not just marginal outperformance, it's a different dimension.
What strikes me immediately listening to those examples is how different their approaches must have been. You've got someone who failed and learned discipline, an analyst, a computer guy.
Exactly. You had pure technical analysts who only looked at charts. You had deep fundamental researchers digging into supply and demand. You had discretionary traders making gut calls. And then you had the pure quants like the MIT grad.
So if their methods, their actual trading systems, were so incredibly varied, what was the common thread? What tied these winners together?
And that is the absolute core of Schwager's discovery. It's the punchline, really. Winning is fundamentally about attitude and adhering to universal principles. It's much, much more about that than it is about the specifics of how you pick your trades.
The what matters less than the how and why.
Precisely. Some traders looked only at fundamentals, others only at technicals. Some held positions for years, others were in and out within minutes. The specific method of selection seemed almost irrelevant.
But the method of execution.
That was everything. The discipline, the risk control, the mental game, that's where the common ground lies.
Okay, so this brings us to maybe the most famous story related to market wizards, Richard Dennis and the turtles experiment.
Ah, the turtles. Yeah.
Because this seems like the ultimate test, right? Can these skills actually be quantified, bottled, and taught? Or is it all just that innate inner radar?
It's the perfect case study for that exact question. Dennis was already a legend, the prince of the pit, they called him. Hugely successful trader.
Right.
And he got into this philosophical debate with his trading partner, William Eckhart.
About the nature of trading skill.
Exactly.
Yeah.
Dennis argued that great trading could be boiled down to a set of rules. It was a skill set. And like any skill set, it could be taught.
Like learning to play chess or speak a language?
Kind of, yeah. His partner Eckhart disagreed. He believed that elite trading was more like an art. It was intuitive, ineffable, basically that inner radar idea.
Yeah.
You either had it or you didn't.
So Dennis, being the kind of guy he was, decided to settle the argument with a real-world experiment. Put his money where his mouth was.
A very high-stakes experiment. He put out newspaper ads looking for trainees, interviewed about 40 people, and over 2 years picked 23 of them to become his trainees.
And the training itself was surprisingly short, wasn't it?
Shockingly brief. The first group got 2 weeks of training. The second group, just 1 week.
1 week to learn how to trade like Richard Dennis.
Well, to learn his system. He gave them a specific methodology and a very strict set of rules to follow.
And the name, the Turtles, where did that come from?
Schwager notes that Dennis had just come back from a trip to Singapore, and he apparently told Eckhart, "We are going to grow traders just like they grow turtles in Singapore." Hence, the turtles.
Okay, so what was the system, basically? What did they learn in that week or two?
At a high level, it was a trend-following system.
Okay, follow the big moves.
Right. Recognizing when a market was breaking out of a range, usually based on price channel models, and then crucially sticking to a very rigid set of rules about position sizing and risk management.
How much to bet on each trade?
Exactly.
Yeah.
It was mathematically determined based on the market's current volatility and their account size. Purely systematic, no guesswork allowed.
And the results? Did Dennis win his bet?
Overwhelmingly. It was absolutely decisive. Out of the 23 trainees, only 3 were considered unsuccessful.
So 20 out of 23 succeeded.
20 succeeded, and they averaged roughly 100% profit per year using his system.
Wow, 100% per year average from people taught in just a couple of weeks.
And these were people from all sorts of different backgrounds: actors, security guards, blackjack players. It proved Dennis's point. The core skills needed for success, managing risk, following a system consistently, identifying trends that could be codified, systematized, and taught effectively.
Even on a short time.
Even in a short time. So the market doesn't only reward innate genius or intuition. It heavily, heavily rewards disciplined adherence to a sound system.
Okay, so if the basic skills can be taught, as the turtles experiment showed, then why? Why do most people, the vast majority, still fail at trading and investing?
Now we get into the really deep stuff, the psychology.
This takes us to Dr. Van Tharp. He consulted with traders for years, right? And he had some pretty, well, brutal insights.
He really did. Tharp's core point was that the market isn't this separate thing over there. Traders bring all their personal baggage, their fears, their insecurities, their internal conflicts right into their trading decisions.
It all comes out in the wash.
Exactly. And because the market gives you instant feedback, win or lose, right now it becomes this perfect, though incredibly destructive arena to act out those personal problems, not to solve them, but to play them out.
And the number one rule, the golden rule of trading, clashes directly with basic human psychology.
It's almost perfectly designed to trip us up. The rule is simple. Cut your losses short and let your profits run.
Sounds easy enough.
Sounds easy, but psychologically, it's incredibly hard. We hate taking small, frequent losses. Why? Because in our minds, it feels like admitting we failed, like admitting we were wrong.
Hurts the ego.
Big time.
Yeah.
And conversely, when we have a winning trade, what do we want to do?
Grab the profit, quick, before it disappears.
Exactly. We rush to take small profits because we crave that immediate validation, that feeling of being right. We're terrified our unrealized gains might just vanish. So we do the exact opposite of the golden rule. We let losses run, hoping they'll come back, and we cut profits short.
Marty Schwartz, one of the wizards you mentioned earlier, he had a really sharp take on this, didn't he?
Oh, Schwartz was brilliant at cutting through the noise. He asked the simple question, why do most traders lose money?
And his answer.
Because they would rather lose money than admit they're wrong.
Wow. That just hits hard. It's pure ego defense.
It's the ultimate ego protection mechanism, prioritized over protecting your actual capital.
Explain that. How does holding a losing trade protect the ego?
It's classic cognitive dissonance, right? Imagine a trader buys a stock, it goes down, they're losing $5,000. Instead of just taking the loss, admitting the initial idea was maybe flawed.
But hold on.
They hold on, hoping, praying it gets back to even, back to their entry price. If it does get back to zero, what happens?
No, they haven't lost money.
Right. And crucially, they haven't had to formally acknowledge that their initial decision was a mistake. They get to preserve their self-image as someone who makes good decisions.
So getting out even feels like a win, even though you might have tied up capital and missed other opportunities.
Exactly. It protects the ego. But while you're busy protecting your ego, you're exposing your capital to potentially huge, even catastrophic losses if the trend continues against you.
Whereas the goal of the wizards isn't necessarily to be right all the time.
No. Their goal is to make money. And for most people, being right and making money end up being mutually exclusive because the ego gets in the way.
Now, Dr. Tharp took this even further. He found that sometimes the psychological traps are even deeper, like subconscious self-sabotage. That sounds pretty extreme.
It does sound extreme. Tharp estimated that maybe half the traders he worked with had issues where, on some level, they subconsciously wanted to lose.
Wanted to lose money. Why would anyone want that?
It sounds completely counterintuitive, I know, but think about it. What happens if a trader becomes massively successful?
Well, they make a lot of money.
They make money, yes. But success also brings immense pressure, responsibility, maybe unwanted attention, and always the terrifying prospect of having a huge public failure later on, falling from grace.
The higher you climb, the further you can fall.
Precisely. So by subconsciously engineering consistent failure, or maybe just hitting a self-imposed income ceiling, they can't seem to break through.
They stay safe.
They fulfill what Tharp called a positive intention. They protect themselves from the bigger risks and pressures that real success would bring. They create a familiar, manageable environment of underperformance because, paradoxically, they know how to handle failure better than they know how to handle massive success.
That's unsettling. It implies that real success requires some serious self-awareness.
Brutal self-knowledge, yeah. You have to dig deep to find and dismantle those hidden psychological barriers, those self-limiting beliefs.
Okay, so let's talk about some specific, dangerous trading habits that often stem from this fragile psychology. William O'Neill, the founder of Investors Business Daily, he pointed out one really common amateur strategy.
Ah, yes. averaging losers. This is textbook mistake number one for so many people.
Explain what that is.
It's when you buy a stock, let's say at $40, then it drops to $30. Instead of cutting the loss, you think, oh, it's cheaper now, I'll buy more. So you buy more at $30.
And your average cost basis comes down to $35. Feels smart, right? Lower average cost.
Feels smart, but O'Neill calls it putting good money after bad. You're essentially doubling down on a decision that's already proving to be wrong. You're taking capital that should be used for strong, high-probability setups and using it to try and rescue a trade that's sinking.
What do the wizards do instead?
They do the opposite. They never average down on a losing stock position. They cut the loss, get out, and look for a fresh entry point if, and only if, the stock sets up correctly again later. Don't throw good money after bad.
Makes sense. Now, Michael Marcus, the guy who went from $30K to $80 million, he learned a huge lesson about position sizing, didn't he? The hard way.
Oh, the hardest way possible.
Yeah.
He needed that trauma, it seems, to really forge his discipline. He talks about wiping out his entire $30,000 account early in his career.
On one trade.
On one single trade. He put too much faith in a story about a corn blight that turned out to be false. Bet the farm, basically.
And lost it all. That must have been devastating.
Absolutely. The despair, the feeling of having to start over from zero, that experience burned into him his most rigid rule. Never, ever commit more than 5% of your total trading capital to any single trade idea.
Only 5% max risk on one idea?
Maximum. Because overtrading, or betting too big, often fueled by wanting to make back losses quickly or just chasing the excitement, that's the fastest way to blow up your account. By strictly limiting your commitment on any single trade, you ensure that even if you're dead wrong, the mistake isn't fatal. You live to trade another day.
Another subtle trap, according to Bruce Kovner, is personalizing the market, treating it like it's out to get you.
Right. Kovner, who managed enormous sums of money globally, really emphasized this. But the market is totally impersonal.
It doesn't care about you.
It doesn't care one bit. It doesn't know you exist. It doesn't care if you make money or lose money.
Yeah.
It doesn't care about your mortgage, your kids' tuition, your hopes, your dreams.
So when a trader starts thinking, oh, I hope this bounces back, or I wish I hadn't taken that loss.
Kovner says they're engaging in really destructive thinking. It's magical thinking, not analysis. The market just reflects the aggregate buying and selling pressure price discovery. That's it. When you start personalizing it, injecting your hopes and fears, your decision-making gets clouded by emotion. You stop seeing clearly.
And then there's the whole idea of following the crowd. Jim Rogers, who co-founded the Quantum Fund with George Soros, had some strong opinions on that.
Rogers is famously contrarian. He argues that the biggest public fallacy, the biggest mistake most people make, is assuming the market is always right.
Isn't that the whole point of the EMH, that the market price is right?
Exactly. But Rogers flips it. He says the market is nearly always wrong, especially when you look at the consensus view.
So if everyone agrees on something, be skeptical.
Be very skeptical. Rogers' point is that conventional wisdom is rarely the way to get rich. If every single analyst, every newspaper headline, every talking head on TV is screaming the same obvious truth about a market, you're probably way too late to the party.
The big money is made by going against the herd.
Often, yes. Or at least getting in before the herd arrives. Rogers even noted, sometimes controversially, that when governments or central banks try to prop up a failing currency or intervene in a market, the smart bet is usually to bet against them, because the very act of intervention often signals fundamental weakness, and that the underlying trend is likely doomed anyway. You need independence of thought. Don't just follow the crowd.
William O'Neill also had some great insights on avoiding the wrong focus when picking stocks. He talked about common metrics people rely on, like low PE ratios and dividends.
Yes, O'Neill did extensive research on what actually characterized the biggest winning stocks before they made their huge runs. And he found the public often focuses on the wrong things entirely.
Like buying cheap stocks.
Exactly. The average person often gravitates towards stocks priced under $10 or even under $5. Why? Because they feel like they can buy more shares for their money. It feels like getting more bang for your buck.
Quantity over quality.
That's the fundamental error. O'Neill famously said, you can't buy the best quality at the cheapest price. His research, which led to his CAN-SLIM methodology.
Right, CAN-SLIM. Can you quickly break down what that stands for again?
Sure. CAN-SLIM is his acronym for the key traits of winning stocks. C is for current quarterly earnings. They need to be up sharply. A is for annual earnings. Growth needs to be strong over several years. N is for new product, new management, new service, something creating excitement.
Okay, CAN.
S is supply and demand. Look for heavy volume buying as the stock breaks out. L is leader or laggard, always by the market leader in industry group, not the cheap laggard.
Got it. Leader, not laggard.
I is institutional sponsorship. You want to see big funds buying the stock, but not too many owning it yet. And M is market direction. You need to be trading in sync with the overall market trend, ideally a confirmed uptrend.
CANSLIM. Okay.
Yeah.
And using that framework, he found that focusing on low PE ratios was often misleading.
Yeah, often a trap. A low price-to-earnings ratio usually means the company's track record isn't great, or its future prospects look weak. That's why the market is giving it a low valuation multiple.
So a low PE isn't necessarily a bargain.
It often signals an inferior company. O'Neill found that the biggest winning stocks often had high PE ratios when they started their big moves, because the market was correctly anticipating massive future earnings growth.
What about dividends? People love dividends for income.
And dividends can be fine for certain goals, but O'Neill argued they can actually be a sign of weakness for growth companies. If a company has to borrow money just to pay its dividend, or if it's paying out cash, that it could be reinvesting in high-return projects within the business.
Then the dividend might be hindering growth.
Exactly. The really explosive growth companies rarely pay significant dividends, especially early on. They reinvest every penny they can back into expanding the business. So focusing only on dividends might cause you to miss the biggest winners.
Okay, so we've talked about why people fail, mostly psychology and bad habits. Now let's flip it. What do the winners, the wizards, actually do? We've established the key difference is their psychological game and their adherence to certain universal principles.
Right. These principles become the action plan, the blueprint we were looking for. And it seems like the absolute foundation, the starting point for all of them, is rock-solid risk control.
Absolutely non-negotiable. Everything else is built on top of that.
It sounds simple, control your risk, but putting it into practice seems to be where the magic, or rather the discipline, happens. Paul Tudor Jones, for example, he operates with what seems like an extreme defensive mindset.
Jones is famous for this. His core philosophy, he says, is the most important rule of trading is to play great defense, not great offense.
Defense first, like a sports team focusing on not giving up points. Exactly. He sees trading primarily as a game of capital preservation. And how does he do it? He starts by assuming every single position he puts on is wrong. Every day.
Assume you're wrong right from the get-go. That forces you to be constantly vigilant.
It forces a state of constant readiness, yeah. He predefines exactly how much he's willing to lose on a trade or on his entire portfolio before he pulls the plug. He has zero emotional attachment to where he got in. He just calls it last night's close.
Okay.
And if his total equity drops by just 1 or 2% during the day, he might just liquidate everything instantly. No questions asked.
Wow. 1 or 2% triggers a full exit.
Potentially, yes. He'll just walk away, clear his head, and come back fresh the next day. His reasoning: it's always easier to get back in than to get out.
Get back in when things look right again, rather than being stuck in a worsening position.
Precisely. This incredibly aggressive defense means his losses are always tiny, microscopic really, which preserves his capital, keeps his head clear, and ensures he's ready for the next real opportunity.
Then there's Larry Hite. His firm, Mint, had this astonishing consistency. I think their worst year was still up 13%.
Incredible track record. And Hite codified this defensive principle into one simple, unbending rule for the entire firm.
What was the rule?
The Mint firm's first rule: never risk more than 1% of total equity on any single trade.
1%. That seems really small.
It is small. If the firm had, say, $10 million under management, the maximum risk they would take on any given trade idea across all related positions was just $100,000.
Why is that specific small percentage so powerful? Psychologically, what does it do?
Hite explained it really well. By keeping the risk consistently small on every single trade, the trader achieves what he called indifference to any individual trade.
Indifference. Meaning one trade doesn't make or break you.
Exactly. If you're only risking 1%, even if you have a string of losers, say 5 bad trades in a row, you're only down about 5% overall.
Which is manageable. Annoying, but not devastating.
Right. It's a recoverable drawdown. It doesn't trigger that emotional panic, that paralysis, or that desperate urge to get it back quick that comes with taking big ego-driven losses. It allows you to treat trading more like an actuary treats insurance risk.
How so?
Well, an actuary expects individual claims, losses to happen. That's part of the business. But they rely on the law of large numbers and their statistical edge to ensure that, over thousands of policies, the company comes out profitable. Hite's 1% rule allows traders to operate the same way. Expect individual trades to fail, but trust that your systematic edge will deliver profits over the long run as long as no single loss can cripple you.
Okay, that makes sense. Now, Bruce Kovner's advice on setting stop losses. This one really seems to go against what most people are taught.
Yeah, this is a really crucial distinction and quite counterintuitive for many.
Most people learn to place their stop based on how much money they can afford to lose on that trade, right? Like, I can only risk $500 on this.
Right. They focus on the dollar amount first. Kovner says that's completely backward.
So what's the right way, according to him?
He insists you should place your stop loss not based on your personal pain threshold or maximum dollar loss, but at the specific price point on the chart that reasonably indicates your original reason for entering the trade is now wrong.
Ah, so the stop should reflect market reality, the technical picture, not just your account size.
Exactly. The stop has to be placed where the market action tells you, okay, the setup has failed, your thesis is invalidated.
But what if that technically correct stop loss point is like really far away from your entry? What if it implies a much bigger loss per share or contract than you initially wanted to risk?
That's the key insight. If placing the stop at the technically correct point means the potential dollar loss per contract is too large for your 1%, or whatever your rule is, risk limit, you don't move the stop closer.
You don't cheat on the stop placement.
No. Instead, you trade a smaller number of contracts or shares.
Ah, you adjust the position size to fit the correct stop, not the other way around.
Precisely. If the valid stop is $5,000 away from your entry based on the chart pattern, but your risk rule only allows you to risk $1,000 on this idea, you simply trade 1/5 the position size you might have initially considered. You prioritize making the stop loss placement valid according to the market structure.
Because if you use too tight a stop, just based on your dollar risk,
You risk getting wiggled out. The normal market noise bumps you out of a perfectly good trade right before it makes the big move you were expecting, which is incredibly frustrating and terrible for your discipline and confidence. Kovner's way ensures your stop is meaningful.
Okay, so risk control is paramount. Beyond that defense, what else drives execution? Schwager noted that discipline was the word that came up most often in his interviews.
Discipline, discipline, discipline. It's the execution engine. And in this context, it really means having a plan, having a system, and then following it. Regardless of fear, regardless of greed, regardless of boredom.
Sticking to the rules even when it's hard.
Especially when it's hard. Larry Haight, again, took this to an extreme. He actually used formal written agreements with his partners.
Written agreements about trading.
Yes, to ensure that the trading system they had developed and mathematically validated was never overruled by some spontaneous emotional decision in the heat of the moment.
Like an external lock on their own impulsiveness.
Exactly. That external accountability helped prevent the trader's ego or emotions from hijacking the process. If the system said sell, they sold. Period.
But discipline can't mean being totally rigid, can it? Markets change. You need flexibility, too. Paul Tudor Jones seems like the perfect example of that.
Absolutely. Discipline needs to be paired with extreme mental flexibility. Jones provided Schwager with a fantastic anecdote about this.
What happened?
When Schwager first interviewed Jones, Jones was intensely bearish on the stock market. He was positioned heavily short, betting on a decline.
Okay, strong conviction.
Very strong conviction. But then, just 2 weeks later, the market action didn't follow through on the downside like his analysis expected. It started to firm up.
So the evidence changed.
The evidence changed. And what did Jones do? He didn't stubbornly cling to his bearish view. He immediately abandoned his short positions, completely reversed his stance, and actually became short-term bullish. He joined the other side.
Wow, a total 180 in 2 weeks.
That's the critical difference between stubbornness and conviction. Stubbornness is emotional loyalty to your position. Conviction, for the wizards, is intellectual loyalty to your process or the data. They show zero emotional loyalty to their open trades. If the facts change, they change their mind. Instantly.
That takes ego out of it again. Okay, and then there's the discipline of patience, waiting for the right pitch. Tony Saliba, the options trader, exemplified this.
Saliba is a masterclass in patience. He treated his trading capital like it was incredibly precious, like ammunition that should only be used for the absolute best opportunities.
Not just good opportunities, but the best.
Exactly. He talked about constantly passing up trades that looked pretty good, trades that probably had a high chance of working out. He waited, sometimes for long periods, only for those setups where he felt he had near absolute confidence.
Where everything lined up perfectly.
All the technical signals, the timing, the risk-reward, everything screamed, go! This extreme selectivity achieves several things. It prevents overtrading and churning your account. It conserves your mental energy and your financial capital.
Right.
And it ensures that when that truly A-plus setup finally arrives, you have the maximum capital and confidence ready to deploy, potentially with a larger position size, because the odds seem so overwhelmingly in your favor.
Okay, finally, let's touch on the role of hard work and maybe the more intuitive side of things. Marty Schwartz, again, he had that interesting journey from being a failing fundamental analyst to a super successful technical trader.
Schwartz's story really hammers home that self-knowledge is key. It took him years and a lot of lost money to realize that success wasn't about finding the perfect trading system in some objective sense.
It was about finding what worked for him.
Exactly. He had to stop trying to force himself to be a fundamental analyst, which just didn't mesh with his personality or his need for more immediate feedback. He switched to technical analysis, focusing on charts and timing, which allowed him to leverage his competitive drive and intuition much better.
And his final rule, after all his other principles.
His final rule, number 10 on his list, is beautifully simple. Work, work, and more work.
No shortcuts, even for the wizards.
None. Elite trading requires intense preparation, constant monitoring of your positions and the markets, and crucially, brutal honesty in your post-mortem analysis of every single trade, especially the losers. You have to learn from your mistakes.
And all this intense work, this deep immersion in the market's rhythms and patterns, sometimes it seems to bubble up in surprising ways, like intuition or even dreams.
Yeah, this is a fascinating, slightly more mysterious aspect. Both Schwager himself and another trader he interviewed, a guy named Jerry, shared experiences of having incredibly vivid, specific dreams that gave them trading signals.
Dreams about market direction.
Exactly. Jerry, for instance, was holding a large long position in the corn market, which had been rallying strongly. He had a dream one night that the market was topping out right at $4.15 per bushel, and the dream conveyed this intense feeling that the risk of holding on for just a few more cents was enormous compared to the potential reward.
Wow. So what did he do?
He woke up, trusted the dream, and liquidated his entire massive corn position the very next morning, right near the absolute peak of the rally, before it turned down.
Okay, so how do we interpret that? Is it just luck, some kind of mystical insight, or is it connected back to the hard work?
The general thinking among these traders, and Schwager seems to lean this way too, is that it's probably the latter. Intuition, in this context, isn't magic. It's more like your subconscious mind processing all that deep experience, all that work, and more work, much faster than your conscious mind can.
So the immersion allows the subconscious to spot subtle patterns.
Right. The intense focus allows your subconscious to pick up on anomalies or shifts that your conscious analytical mind might be filtering out or rationalizing away. Maybe your conscious mind is saying, this strong trend has to continue, but your subconscious sees warning signs.
And if your emotional barriers are down, like when you're dreaming,
the intuition breaks through. It might manifest as a vivid dream or just a sudden, powerful gut feeling. And the key is, if you have a proven track record of disciplined trading and risk management, you should probably learn to trust those signals when they feel incredibly strong.
So let's try to synthesize all these universal principles Schwager pulled out. What are the key takeaways?
Okay, the common denominators seem to be an intense desire to win, to succeed, unshakable self-confidence, but coupled with humility, rigid adherence to a personalized methodology that fits you,
Discipline.
powerful, non-negotiable risk control above all else, the independence to think for yourself and ignore the crowd, immense patience to wait for the right setups, flexibility to change your mind when the evidence changes, the emotional acceptance that losses are part of the game, you can't avoid them, and maybe underlying it all, a genuine love for the craft, for the puzzle of the markets.
Find your method, control your risk like your life depends on it, and execute with ruthless emotional discipline.
That's pretty much the essence of it. Find what works for you, protect your capital fiercely, and follow your rules. #tag conclusion.
So this whole deep dive into the market wizards, it really brings home that the biggest edge in trading, the highest returns, they don't necessarily come from having a fancier algorithm or better inside information.
No, it seems not.
They come from superior psychological resilience. The real battle isn't against the market, it's internal. It's fought inside your own head.
Absolutely. You could almost say your P&L statement, your profit and loss, is just a lagging indicator of how well you're managing your own psychology, your own discipline.
That's a powerful way to put it.
And maybe to leave you, the listener, with one final, really provocative thought, something that takes this internal struggle to its absolute limit. We have to go back to Seykota. Another legendary trader Schwager interviewed.
Okay, what did seykota say?
Seykota offered Schwager perhaps the single most jarring, most thought-provoking comment in the entire series. He simply said, everybody gets what they want out of the market.
Everybody gets what they want out of the market. That sounds deceptively simple. But what does it really imply if you think you want to make money, but you keep losing?
Exactly. What does that quote imply about your real, perhaps hidden desires? If Schwager, with all his knowledge, felt stuck around $100, did he subconsciously want that constrained level of success? Maybe he feared the pressure or visibility that came with managing millions.
And if most traders sabotage themselves by averaging losers or chasing bad trades, do they secretly want to fulfill some inner narrative about not being good enough or not deserving success?
It's a challenging idea, but Seykota's quote suggests that your financial results might be inextricably linked to your deepest psychological needs and conflicts, whether you recognize them or not. Your P&L statement becomes the most brutally honest mirror reflecting your self-assessment, your fears, your limiting beliefs.
So the ultimate trading edge isn't a system.
It might be true self-knowledge, understanding what you truly want, consciously and subconsciously, and resolving those internal conflicts, and achieving that level of self-awareness. Well, that's arguably the hardest work of all, but maybe the most important edge you can possibly acquire in trading, or even in life.